Welcome to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about PLDT is that it pays consistently high dividends despite massive CAPEX needs. This is Andrew Stotts of the Valuation Master Class. Let's get started. Remember, this information is for learning purposes only. This is not investment advice or a recommendation. PLDT is a communication services company in that sector in the Philippines, and it's Philippines' second largest mobile network operator, with a total mobile subscriber base of 71 million people, equaling about 46% of the market share. So the question is, can PLDT regain its lost market share? There's three things to know about this company. First, broadband expansion unlocks growth, but it is competitive. Superior network quality helps to defend market share, and ancillary businesses are important in the long run. So some key statistics. There's 12 analysts covering the company, and there's a target price of $1,888. That's an upside of 0. In other words, it's a hold. The PE ratio is about 13 times, and the dividend yield is a pretty high 4%. My value estimate is about 2,302, and that's about a 20% upside. So I'm much more positive than the analysts out there on this company. So why is that? Well, let's take a look. First, let's look at the sales of the company. Wireless services account for 56% of revenue. 44% is coming from fixed line services. And the breakdown is cellular. Revenue breakdown is cellular data, 53%, and corporate data and ICT, 32%. And then there's home and corporate telephone, 11%. A pretty diversified structure there. And the price and volume have been bullish for this company. Basically, in second half of 2021, PLDT saw a massive 50% share price increase. The increase is mainly attributed to positive news about its latest fintech investments, PayMaya, and soon to launch digital bank Maya. Now, the price signal remains strong as the 50-day moving average is well above 200-day moving average, and volume RSI has been strong recently, so it's providing some support there. So what's the story? Well, number one is broadband expansion, which unlocks growth. But of course, as I said, it's competitive. So I'm looking at the broadband suppliers here and subscribers. And the mobile market in the Philippines is already quite mature. PLDT sees good growth prospects for home broadband. The pandemic triggered, of course, increased demand for fast internet connectivity. And we can see a big jump in the number of broadband subscribers up to about, let's say, looks like broadband subscribers at about 3 million as of 2020. And we're expecting that to go up to a little bit over 4 million in 2021. So PLDT is engaged in an extensive fiber optics rollout, which currently passes 13 million homes, providing strong growth opportunities. Now, its closest competitor has accelerated its rollout as well, and that's Globe Telecom. And PLDT has started much earlier with its fiber optics rollout than its main competitor, Globe. However, during the past 3 years, Globe saw an exponential growth attributed to its high CAPEX allocated to broadband. In 2021, Globe might surpass PLDT for the first time in terms of total broadband subscribers. Now, the point number two is superior network quality helps to defend the market share. What we can see is that in March 2021, the China-backed company Ditto started its commercial operations and challenged the duopoly in the telecom market in the Philippines. And this is mainly owned by China Telecom. Now, throughout the past year, this Ditto has already acquired 5.3 million subscribers, and annual CAPEX is more than 50 billion Philippine pesos. So they're expanding fast. Now, for 2022, Ditto targets to double its subscribers to 12 million, which means it could steal subscribers from PLDT for sure. Now, PLDT offers the fastest internet connectivity in the Philippines. Here's a report published by opensignal.com about mobile network experience. And what you can see in this is that it's on a scale of 1 to 100, 100 being best. And we can see that PLDT on video experience, they're the leader compared to Globe and Ditto. On games experience, they're the leader. Voice app experience, PLDT is a winner. Download speed experience, PLDT is the winner with the highest amount of megabits per second. And 4G availability, well, in this case, Ditto is the winner. And of course, they're focused on rolling out 4G and 5G probably also. And then 4G coverage goes to PLDT, and Globe is quite close there. So PLDT continues to defend its dominant position in terms of network quality. The download speed is almost 2 times faster than both of its competitors. And maintaining a superior quality is necessary to avoid losing customers in a mature market. Hence, I believe that PLDT can withstand the price pressures from Ditto in the near future. Now, number 3 is ancillary businesses are important in the long run. Let's talk about PayMaya. Through its investment in Voyager, PLDT offers the mobile payment solution and e-wallet PayMaya. With 41 million registrations, it's the second largest e-wallet in the Philippines. Globe's Gcash has 51 million users, so it's the largest. Now, the e-wallet business still produces annual losses of about 2 billion pesos. However, that's a drag on profits in the short run. The investment could pay off big time over the long run. Now, driving growth by bundling service. PLDT also tries to grow its data segment by investing in value-added content services such as pay TV. The most prominent one is Signal TV with a C, part of PLDT's investment in MediaQuest. Signal's TV has 3.7 million subscribers as of third quarter 21. Now, remember, Philippines has a population of about 100 million, so there's still room to grow. It allows PLDT to create attractive bundle offers of mobile, fixed line, and TV packages. I believe that complementary services like this are going to be important to realize growth in a mature market. Remember, you can scan this QR code to go to the valuationmasterclass.com blog to download all of the free case study reports. This one will be up within about 24 hours, and you can just go to the link in the show notes below. Let's review the FVMR scorecard. It measures a stock's attractiveness relative to all other companies, and that attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. The scale is from 1 best to 10 worst. Now, here is the scorecard for PLDT. I wouldn't say that it's a super attractive situation right now, and risk is a bit high at net debt to equity of almost 200%. Just to focus in on momentum, there's been a pretty strong, as we've seen, price change, and momentum at the revenue level actually has been strong over the last 2020 and in the past 12 months. So recently I created a short online course explaining my FVMR investing approach. I usually sell it for $97, but for a limited time, I'm offering it for free. Just go to this QR code, or you can see about it in the notes. Let's talk about the forecast. Again, there's 14 analysts, and consensus just doesn't see any further upside. So it's a 0 upside. The majority of analysts has a buy recommendation, but upside is already captured by the recent price rally. Consensus expects strong single-digit revenue growth, which we can see is about, let's say, 5 to 8%. Also, margins are expected to be stable. Let's look at the P&L to understand what's going on. Its investment in the e-wallet company PayMaya is still not profitable yet, and that means it doesn't start to deliver profits until probably 2022. Over time, it could evolve to become a serious profit contributor. Now, let's look at the assets of the balance sheet. I think it's quite interesting to see that net fixed assets are massive. Net fixed assets, as typically is the case of a large company, are in a large company that has a lot of CAPEX. Heavy CAPEX required to expand broadband and 5G coverage to defend market means that net fixed assets is very high. The liability side, we can see there's been an issuance of long-term debt necessary to fund that expansion, and operating cash flows are not sufficient to fund growth internally yet. So the dividend payout ratio is high, which means it could deliver the 4% dividend yield that it's delivering right now. And it's about 60% roughly for dividend payout ratio. And the leverage slightly increased over time. However, I don't expect it to grow much further. It's at about 2.1 times net debt to equity, or debt to equity. It's about 2 times net debt to equity. If you want to learn more about how to value companies, check out my 6-week Valuation Master Class Boot Camp. Class starts on March 7th. It's practical, it's focused, it's inspiring, and it's a network where you can tap into my network. You can save $400 until February 28th. Scan this QR code and you can get it. Otherwise, if you're just listening, go to valuationmasterclass.com/bootcamp to get this deal. Let's talk about valuation. Let's look at the A-Stot's investment research stock picking checklist. It was inspired by Peter Lynch's book, One Up on Wall Street, where he talked about 10 baggers. Those are stocks that go up 10 times. We did extensive research on 10 baggers and found 9 factors that drive long-term share price performance. So let's look at these in relation to PLDT. First is management. The management has a proven commitment to growth. That's moderate. PLDT has lost its market-leading market share, and the growth rate has been pretty slow. That brings us to growth. The product and industry can support a decade of 10% annual growth. Mobile penetration is high. Broadband is the opportunity, fintech also, but still, even with all that, growth has been slow. So both of those are moderate, which tells me at this point, it doesn't look like it's going to be a 10 bagger. Number 3 is sustainable. Competitive strategy creates a sustainably high gross margin. This is moderate. Market is concentrated with 3 players. However, new entrant Ditto could start a price war. Number 4, so we've got 3 moderates. This is not going to be a stock that got a 10 bagger, I would suspect. 4 is quality. Good earnings quality. Non-core items are small or non-existent. Moderate. High fluctuations due to non-core items, but net profit has been consistently positive. Number 5 is efficiency. In the long run, sales grow faster than assets. This is weak. There's a heavy amount of fixed investments required to grow, and asset turnover is very low at about 30%. Number 6 is tight, relatively low cash conversion cycle. Negative is best. Here it's good. The cash conversion cycle is negative. This is mainly because telco companies don't have inventory. Number 7 is cash flow. Operating cash flow is consistently positive. This is moderate. Consistent operating cash flows, but we're not always sufficient to cover the high investing outflows. Number 8 is capacity. The company has access to capital to fund growth. This is weak because the level of leverage of the company right now is quite high. And then number 9, inexpensive. Valuation is reasonable. We want to avoid very expensive stocks. Here it's moderate. It trades slightly lower on both P and price to book, but has a little bit higher ROE. So all in all, I would say this company does not have a chance to be a 10 bagger, maybe a 5 bagger, maybe a 3 bagger, but definitely not a 10 bagger. Now the free cash flow here we can see was negative in 2019, and I expect it to recover, and as it has already in 2020, and then to rise from there. So let's look at the value estimate. These are my assumptions about revenue. Similar to consensus, I expect stable revenue growth over the next 5 years. I'm a bit more optimistic on margins, as I expect the third competitor, Ditto, will not be able to scale as fast as they think. And the result of that is that PLDT still has a place to make and hold their position. Over the long run, I assume PLDT to grow in line with population growth, which is about 2%. So I've used that as my terminal growth rate. The cost of equity is about 11%. So the free cash flow valuation, the base case is 2302. That's a 22% upside. The bull case is 28% upside, and the bear case is 16% upside. Let's review the company's world-class benchmarking scorecard to understand their competitive position relative to peers. We use a composite rank of profitability and growth called profitable growth. The scale is from 1 best to 10 worst. And here we can see that the company is kind of average or actually below average in the past 12 months, scoring a 6 when compared against 270 large communication services company across the world. Profitability is about average and growth is about average. This is an average company. Now, remember, we're comparing this company against other telecom companies, and this company just has average growth. Many other of them have very strong growth. So the key risk is intensified price competition. Less than expected return on CAPEX in a capital-intensive industry is another one. Overestimation of profit contribution from fintech investments is another one. If that doesn't work out, that's going to be a problem. And failure to keep up with technology changes is a risk. The conclusion: maintaining a superior network quality is critical success factor. Fintech investments and value-added services could drive stable growth in a rather mature market, and the high ROE and dividend yield make it an attractive dividend play. So I ask you, can Philippines' second largest telco company, PLDT, regain its lost market share? Let me know what you think about that question in the show notes.